Okay, so I lied. We're not canceling the stream. Our guy just showed up, so we're good to go. Welcome to Solana Circuit number 24. Pretty excited about this one. David and I are both big DeFi heads, and we've been in the trenches for what feels like centuries now. And our friends here at Yo are building something pretty cool, so we're excited to give them the chance to show their stuff and talk about what they're building. But David, how you doing today, brother?
I'm doing good, man. A little tired. Still out on California time. That hasn't changed since yesterday, but we're rocking and rolling. So pretty happy to have you here, Mehdi. Yeah, I guess my first question is what is Yo? Because this sounds like something I would just I would say to my buddy when I see him for the first time in a while. You know what I mean?
Absolutely. We love the idea that it's a common word used by everybody from gangster to normal people. Yo stands for yield optimizer. YO is yield optimizer. And we thought that one of the key pain points that you have in DeFi is when you're harvesting yield, you have to change pools from time to time because the yield is variable, the yield goes down. And so you end up having to have a managed position to move your assets from one yield opportunity to another. Yield Optimizer Yo is basically a protocol that does that automatically. It does that across all chains. It can move, follow the yield wherever it is. And it does that with cognizant of risk. It's a risk-adjusted yield optimizer. And so with that, we basically tackled a lot of the key pain points that retail and normal users had when comparing DeFi yield to a savings account.
And real quick, I want to take a step back here because I feel like we didn't really intro you. Mehdi, let's start from the beginning. Who are you? What do you do? What is Yo?
Yeah, I am the co-founder of Yo, and I started my career as an investment banker. I was at Credit Suisse during the great financial crisis, and I got to really experience risk from the ground up in the sense of like having to understand when things break apart in traditional finance. I also continued my career in frontier investment at the World Bank. Out there at the World Bank, I was doing infrastructure investments across sub-Saharan Africa, and it was a great market, a frontier market, in the sense that you would have to learn about how to structure things from the ground up, like how to assess the risk. You couldn't use historicals or volatility as an assessment of risk. You would have to build things right. When DeFi came up, it was amazing to me because you would see like all these Lego blocks of finance, and you could like use them and like build on top of each other with composability and all of that. And so it was a very interesting case for me to start to look at risk and assess risk and so on. And I love that transparency, and that's what got me into crypto and DeFi.
That is really interesting. I don't think I've ever talked to anybody who's on like the ground floor of the financial crisis. What was that like? Like being there in the moment, actually working in the financial sector when that happened?
Yeah, it was a moment where significant news that impact your life come from the Wall Street Journal, where you could read something in the morning and uh, everything that you thought was stable, like from a bank like Lehman, or from a risk rating like a AAA from Standard and Poor's, would crumble, and basically you are no longer able to go with accepted ideas about what makes sense and what does not. You have to go back to the fundamentals. You have to unpack everything. You have to break apart everything to see if there is something not that does not make sense. If you're using a debt instrument, you would have to look at how it works exactly and go back to where the yield comes from, go back at how is the collateral structured, go back to the fine print. Because finance is actually very composable even on with Wall Street, it is actually super hard to do it. And you also have a lot of things that were not only opaque, but just convoluted through mathematics and so on. And all of that led us to, as an industry on Wall Street, to go back to things that are a little bit simpler after the 2008 crisis. And also like just do things that make more sense.
Yeah, that is so crazy. I bet it felt like your entire world just kind of flipped on its head overnight.
Yes, and everything would break apart day after day, and which is like pretty insane. And I think we see it as well sometimes when we have a hack that is important, like the latest one with RSE, where we see like, okay, well, all of this was an infinite mint. What does it mean? It impacted Aave. Aave is like the biggest protocol in DeFi. Just you end up with like a similar case where you have like everything falling apart.
Yeah, and that feels like it's been happening a lot faster in DeFi recently,
Yes.
unfortunately.
And there is a good reason for that. The main reason is that you have a lot of AI coming in and making it very easy for hackers to find vulnerabilities. And so there's like this moment in DeFi where you have more power for people who are looking for vulnerabilities than people who are like trying to defend their protocols.
Yeah, it makes sense. I mean, there's it just feels like so April I think is like on record as like the worst month as far as hacks go for like DeFi ever. If I recall correctly. And I do think a lot of it is like you were saying, like that AI where it's just like I think it's so important right now for teams to kind of be using these tools kind of against themselves. Because otherwise somebody else is going to, you know what I mean? And
Yes. And that's definitely like the kind of things that we do. We even like use these tools on the protocols that we list. As a yield optimizer, we depend on the yield of other protocols, so we aggregate the yield, and we basically try to look for vulnerabilities in the protocols that are underlying, and that's like something that we've been doing. With using also like AI to see if there are like anything that doesn't sound right, and that led us also to, because of the contagion and the fact that we see an exponential in exploits, it also led us to really go to more and more simple yield and have lower yields these days, right to be like less of a risk taker.
Yeah, and so, with AI coding tools and always on robots that are able to exploit your protocols, exploit software. We saw Claude come out with like this commercial or marketing commercial a few weeks ago about this Mythos model, which essentially says like this model will be able to break software, essentially. Like they found a 30-year-old vulnerability in some sort of package that like every piece of software uses on Earth, which is insane. So are you guys at Yo, are you using AI pretty extensively to like kind of find potential gaps in your security and patch those before someone else finds them?
Yeah, absolutely. For our own security, that's definitely the case. I even like say that we are looking at the vulnerability inside the composability stack, in the sense that we go down one level to look at, if we depend on Aave, for example, to really understand how it works on Aave's side, to be able to like identify even gaps within the underlying protocols.
Yeah, that makes
So
sense.
and I think what you saw is like what you saw is like an increase. If I think about this, the way that I experienced it by being on DeFi 24/7, back in 2023, I would say we had an important, not necessarily major, but an important hack every quarter. Um, the in last year we were having a hack every month in the beginning of the year, and so that's a 3x increase in exploits. And if we look at since November, we had we had a hack every week, and I think in February and March we had a hack every day, and in April we had 3 weeks with 3 hacks a day. And what you have there is it's very much aligned with the ability of these um, AI models to take more and more complex code and be able to find vulnerabilities through complicated mechanics to extort the value, basically. But I think that this is just something, it's a little bit like with everything in war, there is a defense and attack. Sometimes defense becomes stronger, sometimes attack becomes stronger. And so it's just a weapon among others. And it's not over in a year, all of this will be like basically make DeFi more robust, DeFi code stronger, and DeFi yield a better source of yield than it is today. But yeah, right at this time, it feels like there is a lot of risk in the system.
So with Yo, you guys are trying to make yield farming a lot easier. So what would you say are the biggest pain points of someone on chain trying to chase yields? I know for me personally, it's I'll park my money in Aave and get like 3% of my USDC, but then I see a new protocol pop up and all of a sudden they've got like 8, 10% on USDC. Where the yield's coming from, I don't know. I don't ask questions, but that's a pretty big contention for people that are like looking for the best yields on chain. Was Yo built specifically to address that concern and just kind of have like the default savings account for DeFi?
Yes. So basically, yes, Yo is meant to be the simplest way to get yield in DeFi and the best yield in DeFi. And so we always think of it as a savings account. And the way that we think about this is like if you want to have a good yield in through DeFi, if you just do Aave, you may be below the risk-free rate of treasuries, and it's often the case. So we want to really bring the best yield in DeFi, and so that means that we need to look into new opportunities. And so that's the first function. The first verb is to search for new opportunities. Then you have to assess them. You have to assess the risk. You have to assess the whether the yield is going to stay there, whether you're going to have to lose slippage on the way in, whether you're going to have to change assets from USDC to USDT, and things like that. And so, and whether you are in the right chain. Then there's a whole execution layer where you have to execute to go in and out. There is a liquidity question, whether you have to track for whether that pool is going to be a one-way street or whether it could like get not enough liquidity on the way out. And so we have to manage like maturity. We have to manage liquidity on these things to generate that yield. And so all of these things are hard things to do on your own, but they are scalable things to do once for everyone. And so Yo is basically building that scale where we do the research once. We build the pipes to move value across chains once, and we optimize for everyone on the vault.
Gotcha. So I've also built in the past like some like yield related product and stuff. It's always been just kind of very interesting to me. I wouldn't consider myself like a proper money markets guy. Like, those guys are kind of way too smart for me usually. But I did want to ask you how does I know you mentioned that like you have continuous optimization for trying to find the best yields. Obviously, you've talked about how this might be across various chains or and different protocols. What sort of like what's kind of going on the back end, like underneath the hood? Obviously, it's very simple for users. You click a button, and you guys are going to find the best yield. But what I guess like how do you think about like allocating if I deposit like $100 into Yo, what's kind of happening on the back end there? How do you guys decide where that's going to be allocated? What does it stay on the same chain that I put it in? Like how does that all kind of work?
Yeah. So short answer is that whenever someone deposits new assets, these assets go into the top performing pool. And when someone withdraws, it's taken from the least performing pool. So while people go in and out, the vault is basically optimizing across time. There's another function that happens on a weekly basis that also like reviews the potential optimizations based on the change in data on risk and on yield. And if there is like a big gap, that is not that is worth doing, despite the fact that there may be a little bit of slippage. It will like assess the gap, and if it's really good, it will optimize there. So that's the yield optimization algorithm in a nutshell. Now, in order to really know what's the most attractive or the best pool and what's the least attractive one, it's not just a question of yield. There's a question about risk and risk perception. And so we have been building risk ratings for the past 5 years in DeFi. We have published a lot of things about how to assess risk and how to really get to a probability of default for every pool. So we have those probabilities that we apply to the yield. We have also, by building the pipes to move the assets, we know how much slippage there is, and so that slippage we also like include into the risk-adjusted yield, and so that gives us like most attractive a sorting of all the yield opportunities that exist and that are like sustainable in DeFi. There is another question which is related to how sustainable is the yield and what's the yield outlook in a sense. And we take all of this into consideration through the algo to know where to go.
Gotcha. Yeah, you mentioned back in the financial crisis, one thing led to this. I don't know if people have seen The Big Short or are, obviously that's this thing where, it took a while for like the Standard & Poor's like credit ratings and things like that to actually reflect the truth of the underlying market. And that kind of caused some issues. Do you guys see yourselves as potentially at any point kind of doing the same sort of, kind of being almost a data or service provider in the sense of kind of doing these credit ratings, giving and obviously you guys are keeping an internal sort of track of these things, but is that something you guys plan to offer like as a product or as a service externally as well, or do you guys kind of want to keep that in house? Is that kind of more like the secret sauce?
So we have been doing it through the brand of Exponential for the past 4 years, and it was used on DeFi Lemma as like a risk rating for every pool, but we don't see this as a very sustainable business model, namely because of AI again. When you have like data becomes a commodity very fast, and there isn't like a lot of potential buyers for that data. If you think about it, retail is not going to be paying even $5 to know the assessment of a pool. They need to look at that very rarely, and they don't want to pay a subscription for that. They have enough subscriptions. So the only business model that could have existed would have been with companies, but companies with data often also have this idea that they can just copy the data once and leave, and so there's like. With AI, there's like also the disruption of like all the data businesses and the SaaS businesses. And so we are not going there. And we think that our risk model is really special and performant. And so the right way to build this is to basically use it as we have it to build alpha.
Gotcha. Very helpful.
Now, one thing that we are thinking about, and because we don't like this idea that we would be building something on the transparent world of DeFi and keep it for ourselves, is that the whole business of the vault, the whole system of the vault, everything that we built from like automated trading, from the algo of yield optimization, from this ability to automatically withdraw from anything that's risky at an emergency. All of these things are what we call the vault infrastructure that we have built, and that could be like an interesting business to provide to other vault managers so that they can like use that. We don't want to be the only vault in town. Obviously, we think that DeFi is plural, and no one has built vaults that are both on Solana and EVM at the same time. We have done it, and so we think that this could be like a very interesting food package for curators and vault builders.
I would love to get into the fact that you guys are on both EVM and Solana. So a lot of yield aggregators that I know, they usually just kind of stick to one chain, or like EVM will stick to L2s and the main chain. How do you optimize the yield between EVM and Solana? Like how is that possible? How do you get the chains to talk to each other and kind of transfer users' yield between the chains?
Yeah. So this is going to be done first on USD, and it's not public at this stage. But our architecture is meant to be, as you say, multi-chain. It is currently the only protocol that is able to harvest the yield on multiple EVMs, and that's already a revolution. So you can deposit your funds, your USDC on Ethereum, and receive yield from a pool opportunity on Hyper EVM, for example. And so the way that we do it is that these vaults are the same vault being replicated in multiple places, and they have the same price basically. So the vault basically has an identity, but is located in multiple planets, and those and they synchronize at the time zone of Ethereum. The time zone of Ethereum, why? Because Ethereum is the slowest of all the EVM chains, and so when Ethereum says this is the new time, then that's the new time, or that's the new price. And so that price is basically, when you think about yield doesn't change much. It changes, let's say, by 10% a year. It increases by 10% a year. So on a day-to-day basis, it's going to increase by 1 to 3 basis points. And so when you think about it by block, it's going to increase by cents of a basis point. And so it is possible to basically synchronize all these vaults based on the slowest chain, which is Ethereum. And so that's what we do. Now, the part that is interesting is having value move across these chains. So we heavily rely on bridging solutions. because your assets that are deposited on Ethereum can have to go to Arbitrum to do that. So we take into account all the slippage considerations, like the time to bridge. Like Arbitrum, for example, is going to sometimes require a full week to get the assets bridged natively. And most importantly, we do not want to have the risk of the bridge in the middle while we are earning yield. So every bridging needs to be fully native and get the full assets, fully backed asset after the bridge transaction. And so that's how the architecture is built. Now, between Solana and EVM, there's a lot being done by Base to bridge Base and Solana, and we are basically building on that. And there is also Circle is doing great work into giving USDC on Solana and Base and EVM. And so by having that very strong, reliable bridge that is canonical, or at least gets you to the native asset on each chain, we are able to build something that's really powerful, where you could deposit in Solana but earn yield on Ethereum, deposit on Base and earn yield on Solana. And so that's something awesome.
Yeah, that is really cool. And it's a lot more, that simplicity on the side of users, that users experience is not actually what's happening underneath the hood. There's a lot that goes into that. But
basically there's almost a trade-off between the simplest you make it to the user, the more that complexity goes into the background.
Yeah, for sure. I also wanted to ask you, obviously I see you guys are doing Yo Sol. Obviously we're a little bit Solana maxi over here. But we love to see that. But I also saw you guys have a product that is Yo Euro, right? Which I thought was really cool, because I haven't really seen too many products that are focused on non USD based stablecoins. What made you guys want to do Euro lending or Euro money markets?
So a lot of our actual stakeholders or users are wallets or neobanks that want to provide an earn experience based by based over Yo. And so, for example, if you have a neobank in Europe that is euro based, they will want to have native euro yield with euro stable coins and things like that. And so we had Moneda ask us to do that for a long time, and we basically built it for them after we have seen that there were enough yield opportunities and yield sources for the euro. That's how we look at it. We have a request for GBP as well, the British pound and the Brazilian real. But we are still waiting to see more yield opportunities in these two currencies, basically.
Gotcha. Very helpful. Very helpful. So how do you deal with European regulations? So we know that places like the UK aren't super friendly to crypto. How do you guys handle that specifically with the euro asset that you guys have? Have you had to go through a lot of hoops to kind of list that asset on your platform, or was it just a plug and play, you're done and figure it out later?
So on a regulation basis, there are mainly two questions that needs to be solved. The first one is securities law, and the second one is the money transmission laws. On the securities law, if anything inside the vault or the pool is centralized or a security, then the whole pool becomes a security, right? And so it's almost like a radioactive thing that you have inside. So one of the things that we work on and make sure is every pool that we list needs to be decentralized enough not to be considered a security. And so if you have a centralized party, if the profits are coming from the specific work of a team, or that there is active management, then that's dangerous. For us as a protocol, the algorithm is objective, it's transparent, there's a white paper out there. So it is itself decentralized, and it is itself, we don't have custody of the funds. And so all of this makes it like not a security, with the assets, the underlying assets themselves are not securities. We use URC, which is a commodity, not a security. Now, if you look at the transmission laws, it's mostly related to being a custodian of the funds, which is not the case as well for protocols usually, and it's not the case for us. And so we just like make sure that that works as well. And so we end up like in the real world of DeFi and outside the systems that are made by regulators to catch asymmetric information, asymmetric risk, or issues that would create issues for retail, basically.
Gotcha. It makes sense. I know like MiCA was like passed like recently over in the UK. I'm not sure where you guys are based out of. Sorry,
We are based in Miami.
Miami. Okay, gotcha. Yeah. We kind of have like I know historically like the UK and like the EU have been like kind of unfriendly somewhat towards crypto, but it does kind of feel like although we've made a lot of progress here in the US lately, it does kind of feel like some of the like specifically the UK feels like they're kind of catching up even faster than we are in some ways with some of the recent regulations passed. Do you think that that's like a trend that's going to continue, or do you think like the Genius Act finally gets passed and things are great, or how do you kind of see the regulatory regime evolving over the next several years? I guess would be the question.
Look, I think that a lot of this is happening because of the U.S. administration being pro-crypto, and the Republicans seeing crypto as a good vector for that need for freedom that they want to have. Like it's a little bit more freedom oriented, less state control, and that the Democrats have been trying to do and push. And so there's almost an alignment in values with crypto, and that pushes the U.S. administration to actually like also push other serious markets like Singapore or China or the EU to give more credit to crypto and to look at what are the benefits of these new systems. MiCA is just a regulation that typically in the EU is made by people who are smart, who really try to understand things from the bottom up, and sometimes miss a few things because they have not left-leaning, but just preconceived ideas about how things should be fair. And so MiCA is not like amazing, but it's a good start. Genius is typical of US regulations where on one hand it makes a lot of sense. In the fine print, you end up with a lot of caveats for specific parties and banks and so on. But it's also not so bad. So overall, I would say regulation has been improving over the past 2 years a lot. I think we deserve it for all the work in decentralization that has been done by this industry for the past at least 5 years for DeFi. And I think that I am not necessarily sure that this is going to improve significantly going forward, but the fact that stablecoins are taking over the world, and that's happening right now, is definitely going to change the dynamics of looking at crypto just as a problem for regulators to looking at crypto and stablecoins as an opportunity for better business.
Yeah, definitely. Um, I did want to take a little bit of a step back though. You talked about how, that when we were talking about, the kind of the services you guys provide that, you're hoping that maybe some of the stuff that you guys have built that other protocols and people could build on top of it. I know you guys offer like an API. Can you tell us more about that? Like, are there people building cool stuff on top of like the sort of underlying infrastructure you guys have created, or yeah, what's the kind of like ecosystem, I guess, outside of just you guys directly starting to look like?
Yeah, so if you think about a wallet when they want to give you yield, the first thing that they can do with on chain without any API is like interact with smart contract, basically deposit and withdraw. The issue starts when you need some information about the past. For example, you want a yield chart, or you want to see like the description of the strategy. These are not on chain, and you need like more meta information to allow for this to be done easily. And also you also have like some architectures that are not made on Node.js or that are using like specific types of code that is not easily to inject into a blockchain. And so we built the gateways and the API stack so that like wallets and other integrators can very easily integrate into Yo. And so that allows them, for example, to once you have deposited, not only to move the funds through the chain, but also be able to say, okay, well, David, you put $1,000 3 days ago. Today it's $1,001 because you earned 3 days of yield, and so on. You get a P&L, you get everything.
So taking another step back here, what is like the origin story for Yo? I'd like to learn a little bit about like you yourself. What has your journey been in crypto? What inspired you to create Yo, and how long have you guys been around for?
Yeah, we started Exponential in 2021 with the idea that DeFi yield is extremely good. It's the first time where you have a transparent financial system. It's much less opaque than the traditional but it's most importantly, doesn't have the same counterparty risk and asymmetries of information that create asymmetries of incentives and that build all these crises every few years or every decade. So we wanted to make DeFi more accessible. And so what that meant was to tackle all these things that happen, which is like how do you research, how do you custody, how do you execute on a smart contract, how do you sign, how do you keep your money safe. All of these like many issues needed to be tackled. So the first thing we built was the risk rating system. We started to assess investment opportunities, yield opportunities in DeFi, which are basically pools, and give a risk rating to it. The second thing that we built was a way that is easy for anyone to put their money into the pools. And then we realized that users were struggling with choosing which pool was the right one, despite the fact that we had risk ratings, and how to allocate across all these pools, and how to also like have to move funds every 3 months because the yield moved. And so we ended up like looking at this, and the other pain point was they would have money in Base, they couldn't put it on Ethereum or vice versa, or like go on Solana and so on. And so the way that we ended up doing this was like, okay, well, we need a protocol that can accept assets from any chain, that can deploy those assets into any chain, that is intelligent enough to make the right decisions objectively, and that is built in a way that provides a lot more value than if the user stays on their own. And so that's how we got to Yo.
Makes sense. How are you thinking about real world assets as they're kind of coming on chain? Because right now, like a lot of the yield-based protocols are either like some sort of staking yield, right, where you have staked Solana, staked Ethereum, staked whatever. But we're starting to see more and more real-world assets kind of coming on chain, and a lot of those so far have been things like tokenized stocks or other forms of equities. Do you think we're going to start seeing like more active, like fixed yield instruments, things like bonds? Whether obviously it's probably going to be a while before we start seeing government bonds or T-bills issued on chain, right? But I'm wondering if there's like how soon we're going to start seeing things like corporate debt start being issued. And what do you think about the? First of all, I'm not familiar with that market really existing yet on chain, but I don't see why it wouldn't either. Where do you think the puck is skating to, I guess, on that front?
So I think that the first way I think about this is that, well, RWAs are a blasphemy to DeFi because they bring in that counterparty risk, that centralization risk that is not meant to exist in DeFi. So is it DeFi or is it DeFi? And if it's DeFi, is it deceiving the users? And so that part is a little bit hard. I'm still like on the other side, understand why we have to bring in yield from the real world. The real reason we are bringing yield from the real world is that there is not so much demand for like DeFi swaps, DeFi lending to sustain a lot of yield. There is like more capital in DeFi looking for yield than there is yield sources right now. And so the capital for DeFi yield increased more faster than the demand for DeFi services that pay the yield. So that's the first thing. The second part is, well, if the future of Wall Street and finance is built on blockchain rails, it makes sense that you would have to tokenize everything. Now, we went through like 150 years of regulations in the financial system that are actually useful because they stop like those asymmetries of information, those problems that exist when you don't have like the proper propagation of information, and when you have like some people know about things that other people who put their money don't know about, and so all these disclosures are actually super important. We would need to have the same level of disclosures for everything that's tokenized, and I think that we need to also recognize that tokenizing a security is a security as well, even if it's moving on chain. So the on-chain there is mostly meant to have a faster system that is 24/7, that does not require intermediaries as much, and that is allowing to be very efficient. So it's a productivity gain from like a human perspective overall. And so that makes sense. Now we just need to be careful about how do we bring the same disclosures on chain. One of the things that I think is actually very scary is that we're talking about bringing things that are not usually investable by retail to DeFi, and mostly it's going to be retail who will be investing in those and get hurt. And so I'm thinking about all the things that are not simple products, packaged products, the private credit of the world, the corporate credit that includes multiple corporations. These kind of things are complicated and require a lot of disclosures. It cannot be investable by retail users because they don't have the time or even the capacity to assess the risk on these things. And so those are the things that are scaring me when I see private credit coming on chain. I'm wondering, who is it for? And especially when you see at the same time that BlackRock, and which is like one of the best counterparties that exists in Wall Street, is defaulting on the redemptions on its private credit fund.
Mehdi, I gotta ask, have you ever considered a career in rapping? I mean, DCFi is deceiving users. That was that was a bar. That was incredible. I gotta say, that was really something.
Bars.
Well, and CDFI is actually pretty much fine if you're centralized in the front, like Coinbase, and you're using DeFi wallet, like having lending at the back using DeFi rails. CDFI is fine, and it's actually working pretty well. Yeah, but DCFi, when you centralization is hidden behind a facade of decentralization or DeFi, that's really bad.
So we've talked a little bit about RWAs on the stream before. We've actually had Plume Network, which is a pretty big player in the RWA space. They're pretty bullish in RWAs. Your position is that it's really difficult to have RWAs that are as decentralized as DeFi can be, because I mean, obviously you have to have some sort of connection to the real world, and that has by nature centralizing factors to it. Do you think there's a path forward for RWAs where they could be decentralized enough to be able to actually be used on chain, or do you think that's better left for TradFi?
No, I think that they can be used on chain. They require the same disclosures, same level of disclosures and rules as the ones that apply to them in traditional finance. So, for example, if it's a stock, there's like an earnings call every quarter. There are like balance sheets and reviews of the business on a quarterly basis. There are like information about when the CEOs and the directors sell their shares. All of these things need to stay if you want to do it properly, because every one of these rules has been put in place because there was a case of a problem. And whenever there is a case of a problem in DeFi, it happens. It gets exploited. And so that's my initial part. I think that we actually need DeFi to grow. We actually need the RWAs to come in. And the only part that I would say, as an industry, we should bring in simple stuff. But we should not bring in the complexity of traditional finance and sell it to people who don't know how to deal with that complexity. You cannot create like the financial instruments of subprime and come and sell them to DeFi users, because DeFi users are not able to assess the risk of subprime. Actually, investment bankers were not able to do it either for in 2007. And so those kind of instruments, if they are brought into DeFi and they are sold to non-accredited users, investors, people who don't know, I think people issuing those tokens, issuing those financial instruments should go to jail. And they will probably do that, because that's basically almost fraud.
Yeah, it's definitely like a tricky situation, because on the one hand, I believe like, okay, yeah, most people have no business touching these assets. I probably wouldn't want to myself, and I would consider myself fairly sophisticated as an investor. I've worked in trading and worked in a lot of these things. But so on one hand, I kind of think like, yeah, it should be accessible to everybody. But on the other hand, it's like, that's really, really stupid. And does it really mean, like, for most people to actually take advantage of that, quote unquote, because like you're saying, like, they will just end up being burned. And in the great financial crisis, like you were saying, like it wasn't even just retail. Like, these were accredited investors, big investment banks, like these big entities that supposedly should have known better, right? And didn't. So yeah, it's kind of like a little bit of a catch-22, but I wonder if eventually there becomes a way where places like Yo will be able to like maybe do the research and kind of handle some of this on the back end. Obviously, that is a bit of a centralizing factor, like you were saying, that both from the issuance and then the trust factor of like, okay, these people are, whoever I'm accessing these assets directly or indirectly through are doing a good job.
Yes.
But I do think eventually whether it ends well or not, I don't know. But I do think we will eventually start seeing this somewhat because of what you said, where it's like there's more capital on chain looking for yield than there are sources of it. And at some point, that's just going to become attractive. You know what I mean? Where somebody's going to go like, well, I can like pay a lower, interest rate because there's capital over here that maybe isn't available at the same like cheap cost as it is, in traditional capital markets. So I don't know. I think it's going to be really interesting to see how kind of that space evolves. And yeah, just kind of wanted to get your thoughts, but I think you did summarizing sort of the risks and how some of these things.
Yeah, I think one of the key issues that we have with RWAs is also the fact that once there is a problem, and there's always at the moment a problem, once there is a problem for users who were in DeFi, it's very hard for them to go and have a representation in the real world. And so, for example, with Resolve RLP, Resolve created this financial instrument that is on chain, and on chain it had a very clear set of rules, but it had the ability also to it had that centralization risk with the ability to basically block redemptions, and they exploited that to harm DeFi users, and DeFi users being spread across multiple wallets, they cannot. It's very hard for them to get organized and go to court and spend 3 years or paying for lawyers and to get the right thing through. And so this discrepancy in the ability to get to a fair trial and to have representation in the judicial system makes RWAs these hybrid things that are both on the real world and the metaverse, or the real world, the meat space, and the blockchain. And when you have this thing, it becomes a bastard product sometimes. And so if you don't have a very good single centralization party like Circle, for example, that says, I'm not going to do anything, I'm not going to block USDC unless I have a court order, or a Tether that says, I'm not going to block any USDT unless it's an obvious hack. If you don't have some centralization party that is very simple, that tells you exactly what the underlying, what collateral is, that gives you transparency about that, then we get to things that are complicated and that are bound to fail.
Yeah, it's such a controversial subject in crypto in general. Like there's the full decentralization maxis, there's the decentralization maxis with people that say like, hey, maybe North Korea shouldn't be allowed to take everyone's money. But then you have people that are like, it doesn't matter if it's North Korea or not, like code is law. So it's super controversial. And I'm sure we could rant for hours about that. But unfortunately, we only have 4 minutes left. Mehdi, is there anything we did not cover here that you would love to talk about in these last few minutes, or where can people find Yo?
Yeah, Yo is available on yo.xyz. That's basically our website. From there, you can launch the app, you can connect your wallet. It can be both an EVM or a Solana wallet. And so we have an experience that is really special, where you can connect multiple wallets at the same time, see your portfolio added up across all these wallets and chains, and have like your gold on Ethereum, your Yo-Sol on Solana, your Yo-USD on Base, and still see a cohesive wallet for you. Otherwise, I am doing all the conferences, so don't hesitate to talk to me when you see me. And yeah, it's always a pleasure to talk about DeFi and the future of finance.
I will see you at Accelerate, sir.
Yeah, sounds great.
All right. Well, thank you everyone for coming. David, great job hosting as usual. And thank you, Mehdi, for spending the hour with us and talking to us about DeFi. This is awesome.
See you next week.
See you next week.
Awesome. Thanks again so much, everybody. And for those of you who somehow already don't know, tune in on Friday for our next town hall. Last week was the biggest ever. Let's see if we can keep that streak going.
We have to double it, otherwise David and I are fired. I have that in writing.
Yeah.
So please,
Yeah,
please.
they're actually building the guillotine right now. They're gonna throw us on the chopping block.
They are. They shipped part of it to my house today, so I know the rest is coming. It's over.
All righty. Well, thanks so much, everybody, and yeah, we'll see you all on Friday.
Peace.